AMC Entertainment witnessed a sharp decline of over 20% in its share value on Tuesday, resulting in a new 52-week low of $2.46 per share. This drop occurred as investors prepared for an imminent stock conversion scheduled for later in the week. The upcoming event involves the transformation of the movie theater chain's preferred equity units, known as APE shares, into common stock. This move is set to take place just a year after these preferred equity units were first introduced on the New York Stock Exchange. The creation of these units, referred to as APE shares, was devised as a workaround strategy. It allowed AMC to sidestep concerns of dilution raised by investors who opposed the company's attempt to issue more stock the previous year. During the COVID-19 pandemic, AMC managed to generate significant funds by issuing new stock, which proved crucial in settling its debts and averting bankruptcy during a period marked by limited movie screenings due to closures and restrictions. Further complicating the situation, AMC is planning to execute a reverse stock split of its common stock, wherein 10 existing shares will be combined into one share. This action is expected to expand the company's authorized share count from 52.5 million to 550 million after the split. As a result, AMC will have the capacity to issue over 390 million additional shares. As outlined by Eric Handler, a managing director at Roth MKM, in a research report released last week. The upheaval in AMC's share value is the result of a series of developments. In February, the company faced legal action over allegations of manipulating a shareholder vote related to the conversion of preferred stock to common stock and the issuance of millions of new shares. A revised settlement was approved in response to this lawsuit by a Delaware judge recently. The value of AMC's shares has plummeted nearly by half since the announcement on August 14 that APE shares would undergo conversion. Eric Wold, an analyst at B. Riley Securities, suggests that the continuous decline in AMC's shares could be attributed to investors focusing on the probability of the company issuing a substantial amount of equity to address its debt. However, Wold points out that this perspective neglects the potential for AMC's management to leverage access to capital and the company's relatively high valuation for other expansion opportunities beyond its core exhibition business. Wold views the stock conversion as a strategic move by AMC to navigate the extended recovery period for the global exhibition industry post-pandemic, as well as any potential repercussions arising from ongoing strikes in Hollywood involving writers and actors. According to Wold's projections, AMC is not likely to achieve positive free cash flow until 2025. Hence, maintaining additional liquidity is imperative for the company's short-term prospects. Wold's price target for AMC's stock stands at $4.50, which falls on the optimistic end compared to other analysts covering AMC. On the contrary, Roth MKM's Eric Handler has a significantly lower price target of 50 cents. Handler's viewpoint is influenced by a negative assessment of the company's valuation, emphasizing that AMC would need to generate approximately $1 billion in adjusted EBITDA to justify its current market capitalization. This figure surpasses Roth MKM's forecast for 2024 by 78% and exceeds the company's all-time high EBITDA of $929 million recorded in 2018. Nonetheless, Handler acknowledges that immediate liquidity concerns have been somewhat alleviated, at least temporarily.